scroll by, but keep it clean. Let's get right to it, though, and dive into another red-hot day for AMC. The stock rallying 10% to close above $60 a share. Its second highest close ever. So let's take you inside this trade. CNBC's Kate Rooney is kicking us off tonight. Hey, Kate.
Hey, Melissa, that's right. Another wild week for AMC. The stock closed up about 10% today, adding to that eye-popping 2,700% rally so far this year. AMC's CEO, Adam Aron, has really looked to make the most of it. AMC sold shares in January, May, and June to raise money and pay down debt. The CEO saying AMC has raised more than $1 billion in the past 45 days alone. And as a result, S&P upgraded AMC's credit rating last week. The stock is mostly owned by individual shareholders. The CEO says it's about 80% retail investors at this point. But a lot of people are also betting against this name. Almost a quarter of AMC shares available to trade, known as the float, are sold short at this point. The stock is also consistently one of the most mentioned names on Wall Street Bets and other popular Reddit forums. The analyst community, though, a little less bullish there. The price target, or the average price target, $5.25. Meanwhile, the stock is trading around $60 a share. Melissa, back to you.
All right, Kate, thanks. Kate Rooney with the latest on the AMC trade and what's driving it. Tim Seymour, I'll go to you. You know, GameStop was sort of a flash in the pan. Here we are talking about AMC above 60. And it seems like there is some sort of support here, even through this proxy vote.
Well, we've talked about how the momentum and liquidity dynamics are also, very much underpinned by technicals, and we talk about this all the time. And look, without getting into who's short, who's not, and who's speculating and who's not, on some level, what we've seen in terms of the enormous volume in this name, that wherever it originated, whether it was short covering or whether it was someone actually who had a view, a change in management, the ability to raise capital, finally change the balance sheet construct, the ability to maybe to be buying up old theater chains and start life anew. It's really just been a case of where both institutional and retail investors are very much involved in the trade. And I don't, look, I haven't been terribly bullish on the fundamentals here, but I'm also not someone that disregards when the market is telling you something and when you've seen liquidity dynamics that are actually very explainable as opposed to unexplainable.
Right, and I think that's key here, and that is, you may not be able to explain fundamentals driving this stock. Some people say there are no fundamentals, but that doesn't matter in this trade. The trade is the trade. The trade is here. It's at $60 and it's up 10% today.
Key word is trade. I mean, so whether you're speculating here because you think that 60 could go to 120, that could go to whatever because of memes and because of a lot of people really believe that 80% of the float, like Kate just said, is retail. That's not particularly bullish. Not here. Not based on the disconnection from the fundamentals. And I don't mean to be dismissive, but in 2019, this company did peak revenues about $5.5 billion. They lost $112 million. That was pre-pandemic. So if you're telling me that fixing their capital structure and raising cash and giving themselves a lifeline, that's great. Ultimately, for an investment to work out, you need the fundamentals to kind of pair up with the timing, that sort of thing. And that would be my only warning. And you could say, who the heck am I to be warning anybody about this? They're putting their money where their mouth is until it doesn't work anymore. And we saw when the GameStop thing came unwound, there was a lot of people who did very poorly, in that quick precipitous drop, and there was probably a handful of people who did very well.
Yeah. Guy, what's your take on where we are here and how this does compare with GameStop? Because we did see that precipitous drop that really caught some people by surprise.
Yeah, you're going to interview a couple guys. I'm fascinated to hear what they have to say. I'll say I don't think they're trades or investments. There's something different that we've sort of stumbled upon over the last 6 to 9 months. They're vehicles for which people to make money, and in some cases obviously lose money, but I think that's really all they are. They're vessels that people have found. Maybe they're disproportionately, there are people out there disproportionately levered in terms of some of these derivative products, and these guys and gals on Wall Street Bet Reddit taking advantage of it, and the symbol this time just happens to be AMC. I don't think the fundamentals really necessarily matter. That's okay. I got to tell you something. If you've enjoyed the move from, $5 to $65, that money is as spendable as money that you made from $5 to $65 on a fundamental story. It doesn't really matter. And I say good for them.
Yeah. And even if you don't agree with how they're trading, why they're trading, what is behind this trade, Jeff Mills, there are still some positive side effects to this whole movement, let's call it.
There's no question about it. There's good and there's bad. I think we've sort of covered the bad, but just to put some numbers to it, and this speaks to what Dan was saying, I mean, right now, if you're buying the stock, you're paying 9 times forward sales. The long-term price to sales average is about 0.6 times. So really, what has changed to justify that? And I think it's hard to answer that question. And I'm also a little bit worried about the people who are buying late. What happens to them? What is their ultimate experience here? I think that's concerning. But Melissa, to your point, I think the good is very important, and it's very positive that tonight, and I think on a go-forward basis, a lot of people are going to be talking about how the system can be improved. So whether you're talking about settlement timing and DTC, that was the whole Robinhood thing, whether we're talking about naked shorting, dark pools, I mean, whatever it is, I think there's a big opportunity here to shine some light on what truly needs to be fixed. And, kind of the former, the bad stuff, is generating the focus on all of this market plumbing that might need to be changed going forward. So I think it all might be a means to a very positive end.
All right, let's dig deeper into AMC with 2 traders with real skin in the game. Joining us now in a Fast Money exclusive, Trey Collins and Matt Kors, excuse me. Guys, great to have you with us. Welcome.
Hey, appreciate that, Melissa. Thank you very much. It's an honor to be
Trey
here.
and Matt, first of all, Matt, are you guys friends?
Yeah, definitely.
Have you guys done this before, Trey, together?
An interview together? No, this is the first time. But me and Matt have been good buddies for a while. We chat on the phone a couple times a week for sure.
I can tell by your Twitter feed, you guys reference each other and stuff, that there's real camaraderie here in this trade. Matt, I'll kick it off with you. What's the #1 reason at this point, at $60+ a share, AMC will go higher?
Oh, the #1 reason. So there's definitely a myriad of reasons, but I think for me, it's definitely much more of the fact that I would say the stock chart, the stock itself, its price is the scoreboard, and it's the power of the psychological wildfire that the social and cultural movement has taken place, and we're just seeing the impact of that in AMC's ticker.
Trey, same question to you, and I'm sure that you probably echo some of what Matt had said, but in terms of other reasons behind this sort of cultural force that's behind this stock, what is the reason why AMC will go higher, in your view?
I think AMC is going to go higher because you're looking at a new breed in the stock market. You're looking at apes. We're looking at old traditional investing styles and methods, and that's really not what you're watching taking place here. It's a kind of a revolution, you could say, in terms of what's going on for new trading. It's a new opportunity to make money. You can see the story on the chart. The chart is bullish. It's consolidating in that $55, $60 range. That shows strength. It shows that people are holding the stock, anticipating that it's going to go higher, and that's why I think it's going to go higher ultimately.
Let's be clear, because Trey and I got a chance to chat on the phone yesterday a little bit, Matt. Unfortunately, we weren't able to connect. But we were making the point that it's not necessarily the fundamentals. I mean, if you want a fundamental analysis of this stock, you go to traditional Wall Street research. You can pull all that up as much as you want, get the research report that'll say a penny a share, et cetera, et cetera. But does fundamentals ever factor? I mean, in terms of, knowing that AMC has raised cash, knowing that its debt has been upgraded by S&P, knowing that it's going to buy a chain of theaters in California, does that come into play at all in your narrative for the stock, or no, that is a sideshow?
Very, very minimally, much more closer to it being a sideshow. And the reason I'm saying that is, I don't want to completely ignore it, because I know that's the common argument against it. It's fundamental analysis. So in my opinion, the fact that from the start of 2021 until this very moment that we're talking right now, the fundamental trajectory of AMC has improved. So I think that's almost weakening the argument against it. But I just want to reiterate the fact that this is not a fundamental long-term investment right now. This is much more of a swing trade, much more of a momentum trade. It is just a trade. The discussion for a fundamental investment would take place after this short squeeze narrative fully plays out.
So can you guys walk me through, and Trey, I'll direct this to you. Can you walk me through what are the factors in place for this, what you guys call the mother of all short squeezes, to take place?
Well, there's 3 main things that both me and Matt, like to talk about, essentially. And it's the short interest, the gamma squeeze, and FOMO buying, essentially the fear of missing out, right? So you've got a pretty decent amount of short interest. And these shares have been held for a very long time. In fact, 47 days is the average amount of time that any loan has been held on the stock, which means that the average short position is held at $10. they're down substantially, right? So there are some more shorts that can cover positions and run this up. Gamma squeezing, which is call options running from out the money to in the money, can cause this squeeze up effect as well, because market makers have to buy the underlying stock from the market, and that could drive price up. And then it's a momentum trade, right? You're going to bring in some day traders, some swing traders, some people who are looking at the stock and thinking, this is the hottest security in the market right now. I want to be a part of this. I want to make money on it. And those three factors drive into the momentum that has been what you've watched happen the last month.
Matt, what triggers the squeeze eventually? What's it going to look like?
What's going to look like? I mean, I think it's just going to be a very volatile, violent move to the upside. And like, just to give some, like, I guess more of the quantitative numbers to it, what Trey just said, the people who have been betting on this, on average, have had those shares loaned out for 47 days, which means they got in on average around the $10 mark, which means they're down 500%. And to put a number on that, that's over $2 billion. I get it. We're dumb money. We don't know what we're doing, but then why are they the ones down $2 billion and we're the ones that are P&Ls are like insanely high? So right there's just so much pressure against these shorts. I just did a quick rundown on the out of the money options expiring tomorrow for quadruple witching. We're talking 37 million shares. And then the unknown factor of just FOMO buying. People, this story is resonating with people on a deeply human level. And I think that means we're going to see more and more FOMO buying, because why not stick it to Wall Street when you have the opportunity?
How much, Trey, for you, is it the stick it to Wall Street mentality that's driving your personal position in the stock?
I got to be honest with you, Melissa. This is something personal to me. So I come from a place where I wasn't very well off, right? I did not have a lot of money. In fact, there was a summer which I lived in the back of my car, serving and bartending at Buffalo Wild Wings, trying to make ends meet. And I think you get the peak, right? The peak of the iceberg, which essentially is built. The stock market's built around these suits and ties, the hedge funds, the big firms, the 1%, so that they can continue to make money off the expense of a systemic problem that takes money from retail investors. I got an AMC as a swing trade back in January, and after watching what unfolded with Robinhood and some of the halting on trading, so that you could only sell your security, I was mad. I was just flat out angry, and I dug into a lot of the research, due diligence, number crunching, and just learned, educated myself to come to see, hey, this is something that I think people are passionate about. This is a stock that I think has some more upside, and I think can send a message to these big guys on Wall Street to show, hey, the retail investor, we're not that stupid. We know how to make money, and we want to send a message to the short sellers out there saying you should stop betting against us. Simple as that.
There are a lot of issues that are raised on the Reddit boards and the chat boards, Matt, in terms of what is wrong with Wall Street and how things should be. What is your number one gripe? What's the number one problem in your view that needs to be addressed by the SEC or regulators or whomever?
From more of a higher level view, I think it's kind of insane that we've gotten to this situation that two 20-year-olds are coming on the show asking for more transparency in stock market plumbing. The amount of unknowns, the delay in getting data reports, all of it's ridiculous. And right now, we just want more transparency. I think from that higher general level, it's just the field is clearly tilted. We're not engaging in a fair game across the board. There's just different rules for different players, and we're just asking for a fair shot across the board.
Trey, same question to you.
I would speak on the exact same thing. This is something I find very fascinating. It's the amount of retail investors that have gotten into the stock market in the last 12 months, right? Pre-COVID and pandemic, right? There was about 20% of actual transactions on the market were retail investors. Now it's 35%. Now, an even more mind-boggling number is off-exchange transactions, the transparency that Matt was talking about. It's about 50% of actual transactions that take place in dark pools and off-exchange trading. I mean, just the name dark pools, doesn't that, it sounds like something that you shouldn't even trust, and it's not transparent, right? You've got the T2 settlement system, you've got big brokers saying, but look at this, you're saving money on transactions, when in reality, it's really not, it's pennies compared to the millions of dollars that is, coming from the expense of the retail investor.
Matt, I want to get back to the idea that you guys view this as a swing trade, momentum trade. It's a trade, and yet on the Reddit boards, it's diamond hands. And so, are you trading around a position, a core position in AMC, or how are you managing that position?
So for me personally, I've been just continually building on my shares, and then I'll kind of move in and out of different options, and that's just exclusively because they expire at whatever date. So for example, for me personally, I have a bunch of options that expire tomorrow. Depending on what's going on, I might roll some, I might exercise some, but overall I have that core share position that all I do is add to.
Same question to you, Trey, and I'll add to this, what other stocks are you trading besides AMC? Because I'm guessing that you're probably trading lots.
So my kind of strategy, this is just my strategy, right, is I purchase about 80% of my AMC position in stock and the other 20% in options. And I'll roll the options the same exact way that Matt will, so that I can capitalize on the gains and not have to fight theta so much. And you can use those gains to buy more stock, buy more options, and I continue to drive that in. And that's kind of what I've been doing since January 26th or 27th. That's about the first day that I bought AMC stock. But to be absolutely transparent with you, I've got long-term positions that I don't look at. But other than that, AMC is what I've been focused on because I've got that much conviction in the trade. I have since January. Just crunching these numbers, doing the research, I didn't think if $5 was as high as it would go. I don't think a penny is where it's going to go either.
Okay. We're going to have a number of regulators, ex-regulators, ex-SEC folks on this show tonight. So, Matt, just quickly, what's your number one question that you'd like answered on behalf of what you call the ape community?
I would like a lot more insight on the concept of what we're seeing, if they're successfully segmenting all of retail traders, which I think is damaging to the market as a whole. This entire concept of payment for order flow kind of hurting all retail traders. I don't see how that leads to a healthy Wall Street experience.
Trey, how about you?
The audio cut out. Would you mind saying that again?
The number one question that you would have that you'd like answered tonight, we're going to have a lot of sort of ex-regulator, ex-SEC type guests.
I'd like to see what sort of systemic changes we can make. I think there's a huge opportunity to learn from the last 6 months of experience that's taken place in the stock market, specifically around heavily shorted stocks, momentum trades like AMC and GameStop. How do we address failure to delivers? How do we address hard to borrow securities getting naked short sold? How do we address astronomical, margin debt? What are the things that we need to do to fix the high frequency trading? There's a lot of big things that have led to this pivotal moment that we're watching unfold in front of everybody's eyes right now. That's what I'd like to know.
All right, Trey and Matt, we'd love to have you back on. Great to speak with you. Thank you.
Excellent job,
Appreciate it,
boys.
Melissa.
Excellent job.
Trey Collins and Matt Kors. All right, let's talk about this. Tim, what do you think? It's interesting to hear them speak. Very well spoken for 20-year-olds, that's for sure.
Look, their understanding of market dynamics is important. Their understanding of complex derivative markets important. Like it's nice to actually hear of the empowerment of, and they represent a self-proclaimed retail investor class at a time when the market. Look, we've had many periods over the last 10 to 20 years where the sense is that you've lost the retail investor. There's different reasons why coming out of COVID, I think we brought retail investors even more into the market. They include, we talked about this at times when there was less gambling to be done, when there were stimulus checks that could go straight into the market, when there were people stayed at home and they were just bored. But the great news for the retail investor community, I think, is that there's never been more information. The proliferation of information, I think, has leveled the playing field. So, there's fantastic information that's free. There's fantastic information in newsletters that don't cost a lot of money. So I think that's part of the bullish story here.
Yeah. Guy?
CNBC was created to help democratize, and I think to a large extent, when we started this show 14 and a half years ago, that's one of the things we were trying to do was to help empower people. There are a number of things that they said I find fascinating. I don't think, this is just my opinion, I don't think the short sellers are trying to stick it to the retail investor at all. I think they're trying to take advantage of stocks they feel are overvalued and they're going lower. But I don't think it's to try to stick it to the retail crowd. I mean, that's the one place, a few places that I would sort of take a different road. But I understand what they're saying. Again, it's a fascinating conversation, and everybody has different views. My biggest problem with it is I don't think the establishment is trying to stick it to the retail side of things.
Okay. Coming up, the market is broken. That's the sharp indictment from a former trader at Citadel. Why he says the average trader is getting a raw deal. Plus, spotting the next big short squeeze. Data from Ortex out with new numbers tonight. We'll bring you the 4 stocks that need to be on your watch list. As we head to break, let's take a look at some of the according to Think Them Alternative Data. Fast Money's back right after this.
All right, we'll keep going. I guess we'll ride through the commercial. I'll tell you what, I thought that they did very well, Matt and Trey. They did good. I don't really like that guy towards the end. He's chilling. I think that they very much dislike us. I don't agree with his sentiment there that they're not out to stick it to us. I think that they are. I think they're out maybe not to stick it to us. I think they're out to take our money and play unfair games to basically steal money from us. So I think that guy's pretty far off on that. But overall, they did pretty good. And I could tell that there was a little part where Melissa Lee was like, I don't know if I believe you. And he was like, oh, we're not attacking the retail investor. And she kind of like rolled her eyes. I thought that was very funny. I'm interested to see what the Citadel employee has to say next that comes up, or this ex-Citadel employee. That'll be interesting. And then I think they're supposed to talk about some dark pool stuff as well. So apologize for the commercials. Obviously, this video is not really like me doing any DD or anything. We're just kind of watching this together. I do have to give them credit for at least having Trey and Matt on, and I thought that they're talking about some pretty big stuff. I mean, they're actually addressing Citadel right now, which I think is pretty good for us, guys. I'm excited to see possibly what this person says, if it's going to be related to AMC in general or just common practices by Citadel. All right, come on, let's get over these commercials. Let's get through with these. I apologize. This is going to be a longer video. We're already 21 minutes in, gentlemen and ladies, ape and apettes. And I'm curious to see what they say about the dark pool stuff as well. Should be coming back shortly. I do have another video coming out that's going to be after this. I'm going to film it after this interview. We're going to go over some dark pool stuff that's very interesting. Address maybe what some of this dark pool short volume that people are talking about. On my previous video yesterday, I don't know if a lot of people got what I was trying to put down, but some of that short volume that we're seeing in the dark pool could actually be an indicator of strong buying, actually. So I want to share and go over that again with you guys. Damn, these commercials are long. Actually, what I should have been doing here, let's see if I could do this now.
According to financial data from Ortex, 5.5 million shares of AMC were borrowed today. 3.1 million were returned. Short interest rose by 2.8%. With shares up 10% today, AMC short sellers lost $383 million today alone. This, according to Ortex, bringing total losses this year to $4.7 billion. Okay, another name that stood out, Clover Health, a recent Reddit darling, which saw short interest increase by more than 4% today. And turning to GameStop, the stock that started this all, short interest actually fell by 9%. 126,000 shares were borrowed today and more than 1 million returned. And then there's cannabis company Sundial Growers saw short interest fall 7%. 4 million shares were borrowed today, nearly 20 million returned. Jeff Mills, thoughts on any of those stocks we just talked about?
Well, I think you'd be sort of crazy to short AMC or GameStop right here. You know, the fundamentals obviously aren't the driver, and I think these retail traders can keep the prices high for a long period of time, but they're the anointed ones. I think when you start talking about other stocks, there ends up being a coordination issue, and the more the capital gets spread out, I think the harder it is to sustain a move higher in price. And I think you saw that in a stock like Clover. You've seen that in Wendy's. You've seen that in Sundial. These big pops, but then they don't stay and they retreat. And I think that's the issue when you start talking about some of these other names. It ends up creating an opportunity for short sellers because there just isn't enough volume to keep the price high.
Yeah, I would just add that, you know, listening to those gentlemen before, they're talking about these positions that they're long. They're very focused on them. They're spending a lot of their time, their resources, and their capital on. institutions don't really think of it that way. They don't really have one-off shorts. You don't just be a long player and then say, you know what, that looks like a great short. I'm going to lean into that. And really, I think the difference is that, you know, risk management is really important. And I'm sure these guys are focused on that. They got bills to pay and this and that, whatever. And the truth is, the way the markets work, the way capitalism works, is that capital is going to find its most productive uses. And at some point, it's not going to be deemed productive in those stocks. It might be 100% from here, or it might be much lower. So I guess when you're thinking about shorts, hedge funds aren't targeting situations on a one-off basis. They're either thinking about it holistically, or they're putting them in pairs, or they're doing some stuff like that.
First of all, I largely agree with everything you said, but I do think that hedge funds, short sellers can have directional hedges, or they essentially could have tactical hedges, or they could have, in some sense, hedges that are there to be correlation hedges. So if you see a broken company and you're going after it, you're playing offense. And shorting stocks, especially finding broken companies and going after structurally flawed companies or broken companies, or ones that, for a lot of different reasons, whether it's balance sheet or other, is the hardest thing to do. And I actually think that as a guy that ran a long-short hedge fund for a long time, that on the short side, one of the problems is you can have a view and you can be right, but you can compound the position by being long and short. And pairs trades, how often do those work, Dan? I mean, it's very rare that you get the derived response. And anyway, so I think it's a tough environment to be doing any of that right now.
The last point I would just make is concentration. These guys are very concentrated long, right? Like, that's the trade for them. But on the short side, I don't think that you're going to see an institution's hedge funds in particular.
Book is in.
Right. You would keep one position at like a low single digits percentage of the whole book, right? And then you risk manage it. Melvin was doing something that I don't know of too many smart hedge funds are doing. You're not pressing a single digit stock because it can only go to zero, right? It's asymmetric. And that's what these guys got right. That's what they got right at AMC at $2. It's a crapshoot at 60.
All right. We are just getting started here on Fast Money. Here's what's coming up next.
Are we dealing with a broken market? A former high-frequency trader joins us next to lay down why he says retail traders are getting a raw deal. Plus, which stock is going to the moon next? Our own Pete Nigerian is bringing some names that caught his attention. We've got that and a lot more when Fast Money returns.
We'll probably keep going for the Citadel employee, and then we'll end it there. I don't think I'm going to listen to everything they're talking about with the other stocks. Very interesting overall, though. Let me see here if I could get this to work. I'm trying to pull up while we're here. Okay, this should work. And then if I do this. There we go. AMC currently at $60.25, and GameStop is at $223. AMC, I mean, we had just some nasty ripping today. Look at when the market opened. It's just green candle after green candle.
That we've seen, or where there are stocks that have high-level retail participation, the vast majority of order flow can trade off of exchanges, which is problematic. That price formation is not really reflective of what supply and demand is.
That was part of my conversation with NYSE President Stacey Cunningham at CNBC's Evolve Global Summit yesterday. Catch the whole interview right now at cnbcevents.com/evolve. Let's get into her comments, because this is a major gripe of this crowd, and that is that there's no transparency. And those comments get right, in fact, to the heart of it, that about half of total trading, I'm saying total trading, all stocks in the United States happen off exchange. And so is therefore the price we see scrolling at the bottom of the screen on the ticker, does that actually reflect true supply and demand if half of that's off exchange?
Well, if that trend is growing as it appears to be, it's distressing. It also means that people are probably paying more for their trades. The bid-ask gets wider. I mean, there's different dynamics here. And as I said earlier, the proliferation of information is the best thing that ever happened to not just retail, but to institutions, too. I mean, let's be clear. The playing field has been leveled between the buy side and the sell side a long time ago. And it used to be that the only guys that had the pricing insight were the guys making the prices. And so, look, I think it's all moving into a place where technology has democratized the industry. And I think largely there is. But your point about execution that's going on away from exchanges, and is that misleading investors as to actual real price discovery? Of course it is.
And then, of course, for certain names like an AMC, those percentages are much greater in terms of the difference off exchange and the difference and the amount on exchange. AMC is one example. A lot of these Reddit stocks are examples where much, much more in terms of a higher percentage of the order flow is directed off exchange. Guy, do you think that this is problematic? I mean, you know, to the retail investor, it might look like there's two sets of prices or there's two systems in place.
Yeah, it's fascinating. I really don't know how to answer that. I'd be curious to hear what the regulators say, but I'll say this, you know, to think any of these situations have just been your run-of-the-mill short squeezes, I don't think that's really, I think it's a bit of a false narrative. I mean, we talked about this with Rich Greenfield a couple weeks ago. AMC's probably traded a few billion shares. It's given ample opportunity to any just run-of-the-mill short to cover their positions. I've said all along that these are probably more highly levered derivative positions that take place off exchange. And if that's problematic, it is what it is. But these guys and gals at, you know, the Reddit, the Wall Street Bets crowd have intuitively understood that that goes on, and they're taking advantage of it, which is the point I've been making all along. Again, I don't think that those positions were put on to stick it to the retail investor. I think they were put it on to try to make a lot of money for their funds and their investors, and they've just backfired on them. It's a fascinating set of circumstances that have literally taken place over the last 6 to 9 months.
All right, our next guest says the current market structure is broken and retail traders are getting a raw deal. Let's bring in Dave Lauer. He's a former high-frequency trader at Citadel. He is now CEO of Urban AI. Dave, great to have you with us.
Thank you so much, Melissa, for having me on. It's a real treat.
Why a raw deal? What about the deal is raw?
Well, I think there's a lot about our current market structure that's overly complex. And if you ask any regulator, they will tell you that this is not the market structure you would design if you were starting from scratch. And it's something that's been layered on year after year and decade after decade. And frankly, the point that we've gotten to is one in which a lot of incumbents have been able to structure it exactly how they want it to be structured because they're making a lot of money and they are able to wield a lot of political power. And I think we've really lost sight of the two primary purposes for markets, which is price discovery and capital formation. And price discovery is so critical, and that happens mainly on stock exchanges, on lit markets. So this issue that you just brought up with half of all trading taking place off of exchange and 70% or more in stocks like GameStop and AMC, I think is a real problem, and it's costing everyone money. It's costing the retail investors money who are trading through their brokers and all of whom's orders are being sent to people like Citadel and Virtu, but it's costing pension plans and mutual funds money because they're the ones trading off of the exchange quote. And if that quote is wider because of all this off-exchange trading taking place, and by some estimates, 25% or more is how much wider the spread is than if all of those retail orders were to make it to the exchange. So if they're trading against a wider spread that's 25% too wide or artificially widened, that's costing pension plans money. That's costing mutual fund companies money. That's where retail truly has all of its wealth. And I think that's a big problem.
So they're getting a raw deal because they have to pay more under this current antiquated system that was built by incumbents, you say?
Yeah, that's right. And when you have the internalizers in a de facto duopoly, you have other issues around corporate concentration of power and antitrust. And Gary Gensler has said exactly that in his SEC testimony, or in his congressional testimony when he was becoming the SEC chair, and in his first testimony. This is an issue that I think is going to get a lot of attention, and I think that concentration of information is also problematic, right? If 70% of GameStop is trading through Citadel and Virtu, and they're also making markets on exchange, and they're the designated market maker on the NYSE, for example, they have a huge information advantage. And that kind of information advantage means that they have a lot of power to set the price of that stock. Now, it doesn't mean that they're affirmatively manipulating it. I'm not saying that, but it does mean that they have a lot of power and they can swing it, in all sorts of ways to help improve their profitability or change the quote at which they're then internalizing.
Hey, David, it's Jeff Mills here. Quick question for you. Obviously the SEC regulation cycle is very long. We're shining a light here on some issues that impact retail traders. Is there anything that they can actually do today to better position themselves for the environment in which they're operating?
You're asking in terms of what should regulators be doing?
What retail traders can do right now? Like, are there any actionable insights that they can take away from this discussion other than the idea that, yes, they are disadvantaged, but is there anything they can do to better position themselves given the present circumstances?
I think so. And I think that they can take a good, long, hard look at their broker. And how does their broker handle their orders? Now, if you're a retail trader, it is very difficult to get away from a broker who is sending your orders to this duopoly of internalizers. However, when the retail broker sends their order to an internalizer, the internalizer has a certain amount of profit that they're going to make, and then they have a certain amount of money that they can rebate back to either the broker or the retail client. So if they send it back to the broker, that's payment for order flow. If they send it back to the client, that's price improvement. They get a better price on their execution. Some brokers take nearly all of it as payment for order flow. Other brokers don't take any payment for order flow. They just give it all back to their client as price improvement. So if you're a retail investor, you can say, well, I probably want to go with the broker who gives me everything in price improvement. That's going to add up over time. And it does get to another issue that I think regulators need to address, which is best execution. And are these retail investors really getting best execution if you're measuring it against an artificially widened spread, and it's okay for some brokers to take everything in payment while others are giving everything in price improvement? I can't see how those things can possibly both be best execution. But the problem is, if you ask a regulator, they will tell you, and this is a direct quote, that trying to enforce best execution is like trying to nail Jell-O to a wall. And I think that's a real problem for markets.
Yeah, I'm not a big fan of Jell-O, really never have been. But what I'll say is, it's interesting, we're drilling down on one very specific thing, but would you submit that the playing field in terms of where we were 10 years ago to where we are now in terms of the retail has never been narrower? My sense is the playing field has never been flatter than it is now, your comments notwithstanding.
Yeah, if you're going to compare to, early days of Reg NMS or pre-NMS, there's no doubt that the electronification of markets has been an incredible trend for everybody, both the institutional asset managers holding money, holding the wealth of retail, as well as individual retail investors. I would never deny such a thing. But I think if you're looking to assign reasons for that, it's hard to say that the increase of off-exchange trading is helping, or it's hard to say that the practice of internalization is helping relative to something like decimalization, which dramatically brought down costs for people without all of this complexity that we've then introduced.
Last question, Dave, and that is, since you worked at Citadel and you have comments about what you call this duopoly running off-exchange trading of Virtu and Citadel, do you think that they use what they see in terms of order flow to their advantage?
That seems like a dangerous question to answer. And so I would never say, I would never accuse anybody specifically of manipulating markets or anything like that. But I think that having that kind of information is suboptimal for markets. Having that concentration of information is not where we want to be. I believe in open and free competition for order flow. And I believe if you send all of those retail orders to lit exchanges, you would compress spreads for everybody, and those retail orders would get just as good, if not better, execution because of competition, which is something that if you're in markets, you'd think you would support, just completely free and open competition.
Dave, great to speak with you. Thank you.
Thank you for having me. I appreciate it.
Dave Lauer. All right. Dan, what do you think? Because payment for
Absolutely
order
love what he
flow
said.
helped the retail investor get to $0
commissions.
trading.
Yeah, I mean,
so
that's Robinhood, that's robo advisors.
Of that model.
I don't know who's complaining about what. I mean, they only complained when Robinhood shut them down and didn't let them trade, but they were perfectly happy to have a free iPhone app that let them trade all day and night and give them margin to do it. So, at the end of the day, it was the on-ramp for a lot of them. And are they complaining about payment for order flow? Are they complaining about being the product, you know what I mean, not the actual service, that sort of thing? I don't think so anymore. And I suspect a lot of them have gone back to Robinhood because they're perfectly happy for it when it's open for business, right? So, and I just say one other thing that Guy made a great point is, like, markets have probably never been as transparent. You can talk about all this off-exchange sort of volume. It's always been that way. Tim, you remember trading on the buy. You'd go up in a big trade and it didn't print for hours.
Sure. It traded in pluses. And
so it's liquid and it's transparent and it's easy.
The muni market was another example of very limited information.
The biggest market in the world.
But I will push back and say, back then you could have said that's the way it is, and then just say, okay, let's let it be. But that wasn't the answer either. We are in an information age of everything electronified, so why not have more transparency in this market? Jeff Mills, for you, the notion that that spread is wide between lit markets and off exchange, to you, should that be rectified? Should it be a tighter spread? Should everything be going to a lit market?
Yeah, I mean, first of all, I think there's a misconception that people like me actually want some sort of rigged system because, we're big money managers, we manage billions of dollars, but generally we are slower moving long-term investors. We're not trading in dark pools, things of that nature. So I think a lot of these big money managers, quote unquote, actually have interests that are very much aligned with the retail investor. So I think anything that can be done to improve liquidity, improve price discovery, I'm certainly supportive of that.
All right. Coming up on this special edition of Fast Money, get ready for liftoff. Our own Pete Najarian's bringing us the names that could be going to the moon next.
That is what dark pool, I think, throttles the most is price discovery. Talking about all these things, and and I'm going to cover this more in the video after this, but there is a case to be made. Like we're looking at this stock information where it's showing the short volume on the dark pool. But I'm becoming a subscriber to the belief that short volume is actually an indicator of buying power of buyers going on in the dark pool, which could possibly be a better thing for us. That being said, I don't think the dark pool should exist. I'm not trying to glorify it. I just think that some of the data could be construed as really scary when I don't think that necessarily is the case. So that being said, this is a great video. Trey, Matt did wonderful. I thought David Lauer did pretty good too. And Melissa Lee definitely does seem like she really is an ape. So that being said, hope you guys enjoyed the video. Great job, guys. Peace. Love you long time.